Joining me here in studio, Chris Recker, Chief Investment Officer at AZA Capital Management. Chris, great to have you here.
Thanks, Oliver.
Super bullish day. We finally got that breakout all-time high in the S&P 500. The chip makers are going ballistic, saying that the end of the down cycle is behind us, and we're doing it even as we drop the odds of a rate cut in March from 70 to 50. So, I mean, what could go wrong? Or are we just blasting off?
I think a lot of things can go wrong. I think that what's going on in chips is partly a function of these advances in AI, but also the investment the United States has made through the CHIPS Act to domesticate chip manufacturing. And so I think there's been a lot of incentives for investment, and there are national security needs behind it too. So I think that is really driving that part of the sector. A lot of things are coming together, but I think what could go wrong is just this iceberg of 500 basis points in rate increases that have still yet to feed through the system.
The market thinks we're going to undo them.
They're still going to have lag effects. And generally what we see is the markets become more challenged as we enter rate cuts. And I think that's the real question, is why are they cutting rates? Maybe we're in the soft landing now. Things have slowed down, moderated. Things still look very good. But what's the rationale to cut rates? Inflation is down to 2%. If the U.S. economy is still continuing to operate at real GDP levels of 2 to 3% and employment's low, there's no need to cut rates, because you can sustain 2.5 to 2 to 3% real rates and grow over time and maintain the right types of incentives to rebalance the economy. So that is the real needle they're going to have to thread. But in every other time they've done this in the past, they've had a recession.
Thing is, when I look at the way the market responded so quickly, it seems, when they first started hiking, the problem I have with the searching for the lagged effects right now is that if you believe the stock market has any utility, it looks like they got blasted because of the hikes 18 months ago, or 2 years ago now, with the peak in the bear market. We saw some massive crashes. A couple companies disappeared. A couple regional banks went bye-bye. I mean, is that not good enough for the effects of the hikes to have shown through already?
I think that's the strongest case you can make, is that we've had the recession, we've had the slowdown, we're re-accelerating out of it. These strong investment effects from tech are going to lead the way, and housing is starting to recover, money supply is growing. I think that that there's a possibility that could be the case. Okay. But what we would say is that you're starting to see, for every good thing that we see, we can also say that there's a thing that we've seen historically. We've seen manufacturing employment, a lot of these other areas in the productive side of the economy, professional services. That employment's been flat for almost 12 months now. We see weak private growth. Where you really see what's been sustaining this economy is government spending, and that 8% of GDP deficits. What are we getting for that, I guess, is the question. And so generally what we're seeing a lot of that money be directed is unproductive spending, and that even there's no free lunch. And so eventually that will come back to haunt us. And even if we do have this soft landing and we feather through this situation, what are the long-term growth dynamics for the U.S. economy?
Okay. As far as the equity market in the near term goes, obviously we've gotten more expensive over the last year. In the last couple months, we've started to see earnings help offset that a little bit. But when you look at valuations, how concerning are they when we're still below where we were at the post-COVID peak? I mean, do we have a little bit of breathing room at all? I know they're high. We got your chart up here.
They're extremely high. Oh yeah. So look, this is basically a Z-score on valuations for the past 25 years, and this era has been the most expensive, or the highest level of valuations in U.S. market history. There may be good reasons for that, but we are near the upper end of the range, about 1.5 standard deviations above this average for this period, across multiple measures. It just means that we're priced for a very good economic outcome here, an outcome that we think is the odds are not that great. And so even if we do get, everything does work out, what are we being priced for, especially when you can buy almost risk-free bonds for 4 to 5%, and you can get good corporate rates close to 5.
Think it's still compelling to lock in fixed income right now?
We still like the shorter duration fixed income. We took on some duration in the fall. And if this deflation trade works, the longer duration will work out just fine. But we think, relative to the risks out there, to earn 4 or 5% here with relatively low risk is just a great spot to be.
Looking at earnings growth, which obviously crashed last year, but have started to bottom out. How does that correlate with the Fed path? Because if they're at least done hiking, and we've already kind of seen this earnings bottom, then do any cuts at this point just kind of add juice? Because I guess it sounds like you would argue the risk is more like a credit slowdown style risk, and it seems like to me if there's no credit risk, is there inflation risk? But then the Fed has said they're done hiking. It's just kind of seems like we're stuck in this Goldilocks thing.
That's right. And that's what it always looks like before a recession. So the chart you have here is basically Fed funds, rate hikes, cycles, and then post the peak, you generally see an earnings recession. Now we've had a really shallow earnings recession, not much of one. So what we would say is long-term earnings are going to be in line with long-term nominal GDP growth.
Okay.
That's been 4 to 5%.
You're looking for that blue line to go even deeper negative, because the blue is the earnings year over year.
Right. So if I look at this rate hike cycle of 500 basis points and compare it to the Volcker cycle, it's almost as big because there's so much more private debt outstanding.
Okay.
So if you look at private debt outstanding, take out the financial system and the government, it's about 185% of GDP. And so when you normalize the 10-year to that number and compare it to the 80s, that was, the 80s maybe had an 800 to 900 basis point rise up. This is about a 600 basis increase. Now the beta on our debt's a little bit different because of the structure of the debt, but these effects are going to be felt because people are going to have to refinance. 3 years ago, the 10-year was at 65 basis points. It's 415 right now, roughly. So that as corporations go to roll debt, their interest costs are going to go up. We're coming out of an extraordinary period of 15 years of 0% rates. Mm-hmm. That's going to, interest costs have kept profit margins higher. Those costs are going to go up regardless. Even if they took Fed funds down to 3.5%, which is probably 3 to 3.5% is a neutral rate, you're still going to have a higher interest rate structure for most companies.
When does this start to kick in? I mean, we're seeing stocks trade like the ones that people were worried were going bankrupt a year ago, the zombies, et cetera. If we just kind of approximate that by looking at the Russell 2000, it has been the weakest. So I think the market kind of realizes that risk you're describing,
right,
but it still has been firming up, like their lifespan has been extended. So where did it get extended to?
Well, that's a good question. I think really that's going to depend on the path of rates here over the next 2 years. If rates, I think the market's pricing like 7 rate cuts. I think that's very aggressive. But if it's that aggressive, things have to be bad.
Okay.
And so basically a lot of these markets are pricing, we're going back to close to 0% rates.
Yeah, the obsession with kind of the zero bound, like we have to go back there, does seem to be like it, at some point should be an issue if it's not going to happen. But we know that Powell generally does what the market tells him to do, though the language from the Fed speakers this past week seems like they are very much not on board for March. But does the market care about that if it's more a question of when, not if? Like if the Fed were saying no cuts at all, I feel like we probably wouldn't be here. But it seems like they are saying cuts, just maybe like a month after what the market wants them to do.
Right. I mean, we were in this spot May of last year, where they were looking at 150, 200 basis points in rate cuts
right after regional banks.
Right. So where are we now? We're back to the same spot we were, and so we're just keep on replaying the same game, and we're waiting on this data to come through on inflation and economic growth. And the longer that this is delayed, the more that they're going to delay their rate cuts. And the more that they delay rate cuts and the more moderate the rate cuts are, the more this interest cost phenomenon is going to feed into the corporate sector and the private and the
So do I just then, as a stock trader, do I look at my holdings, my 401k, whatever, just make sure that I'm up in quality, the high quality? That's kind of what the Schwab Research Center's been pounding the table on for a year, and it's worked pretty well so far.
I agree with that. I think if you need to be in the stock market, I would look at some of these areas like a Pepsi. Even though those are 22 times earnings, have a 3% dividend yield. That's just a really great place to hide out. The chips run. If Intel at $48. That I could see that being a double in 3 to 5 years but they have very elevated execution risk. So there are spots you can pick in the market, whether it's tech or in consumer staples or those types of names where, you can pay a little bit elevated multiples, but you'll probably be fine over time.
Like that. All right. Chris Recker, a macro guy with a couple micro stock picks for us.
Yeah.
Thank you, sir. All right, great to catch up. Good
Thanks,
to see you.
Oliver.
Happy New Year. Chris Recker, AZA Capital Management here in Chicago.